It wasn't a glitch in the trading algorithms. It wasn't a sudden discovery of a massive new vein of ore. It wasn't even a shift in industrial demand for solar panels or electronics. It was the inevitable mathematical consequence of a market where paper claims outnumber physical reality by hundreds to one. The pattern is unmistakable. The arithmetic is merciless. We are watching a recurring historical phenomenon where the map is confused for the territory, a mechanism where the receipt for the gold is traded as if it were the gold itself until the leverage breaks, until the margin clerk calls, until the illusion of liquidity evaporates in a single afternoon. History shows us that when an empire reaches the limits of its expansion, it turns to financial engineering. It replaces hard assets with promises. It replaces silver with base metals. It replaces value with volume. And in every single instance, this detachment creates a zone of extreme volatility, a zone where prices crash violently downward just before they explode upward. The uninitiated look at the screen and see a loss of value. The historian looks at the same data and sees the desperate liquidation of a bankrupt system trying to maintain control. This is not a conspiracy. This is a structural necessity of a debt-based paradigm. The incentive is to suppress the thermometer, to hide the fever, to understand why silver can crash 30% in a day while demand is at record highs. We must look past the daily news cycle. We must look at the architecture of imperial decline. We must examine the specific mechanics of how dying currencies fight their final battles against real assets. The record is clear. The precedent is absolute. We will examine 3 specific historical case studies that prove this is not a modern anomaly, but a timeless cycle. We will look at the Roman Empire's debasement. We will look at the Spanish Empire's leverage crisis. We will look at the Weimar Republic's volatility. Then we will map these events directly onto the modern COMEX paper markets. The evidence suggests we are approaching a breaking point. The first clear example of this separation between face value and real content is the Roman Empire, specifically from the reign of Nero to the crisis of the 3rd century. Rome did not have high-frequency trading algorithms or futures contracts, but they had the original form of paper silver, the debased denarius. At the height of the Pax Romana, the silver denarius was the reserve currency of the known world, trusted from the chaotic markets of Alexandria to the frozen frontiers of Britannia. It was trusted because it was real. It contained approximately 4.5 grams of pure silver. But the costs of empire are relentless. The legions required payment. The bureaucracy required funding. The bread and circuses required constant liquidity. Under these constraints, the rational move for the Emperor Nero in 64 AD was not to cut spending, but to alter the accounting. He reduced the silver purity of the coin from 100% to roughly 90%. It was a subtle shift, a shortcut, a way to mint more coins from the same amount of bullion. The citizens accepted the coin at face value, believing the state's stamp was a guarantee of worth. This was the ancient equivalent of a paper derivative, token that claimed to be worth more than its physical reality. By the time of Septimius Severus in the early 3rd century, the silver content had collapsed to barely 50%. The state was minting coins that were essentially copper washed in a thin layer of silver. Think about what that means for the saver. A Roman centurion, saving for his retirement, was holding assets that were literally rotting from the inside. The spot price of goods in denarii began to rise, but the volatility was extreme. There were moments of panic where the perceived value of the currency would crash, not because the silver itself was worthless, but because the trust in the state's stamp had evaporated. The government attempted to force acceptance. They mandated that the debased coins be accepted at par with the old pure silver coins. This is the ancient version of the paper price, suppressing the physical price. Gresham's law took hold immediately. The bad money drove out the good. Real silver disappeared from circulation, hoarded under floorboards and buried in clay pots, leaving only the worthless paper coins in the marketplace. The crash in the currency as purchasing power was not a straight line. It was a series of violent spasms. In 301 AD, Emperor Diocletian issued the edict on maximum prices, attempting to freeze the cost of goods by law. The penalty for violation was death, yet the economic gravity was stronger than the threat of execution. Merchants simply closed their shops. Goods vanished, the economy collapsed into a barter system. The paper price of silver was fixed by the state, but the physical metal was unobtainable. The middle class, the backbone of the empire, was wiped out not by war, but by the divergence between the state's official value and the market's physical reality. Just like the Roman debasement created a false perception of value, the Spanish Empire of the 16th and 17th centuries created a crisis of leverage that mirrors our modern futures markets. Spain had discovered the mountain of silver at Potosi in modern-day Bolivia. The influx of wealth was staggering. Galleons laden with hundreds of tons of silver crossed the Atlantic annually. But the Spanish crown, led by Philip II, managed to spend the wealth before it even arrived. This is where the concept of leverage enters the historical record. The king did not wait for the ships to dock in Seville. He issued *Asientos* contracts with Genoese and German bankers, specifically the Fugger banking family. These contracts were essentially futures contracts. The bankers advanced gold and credit to the crown to fund wars in the Netherlands and against the Ottoman Empire using the empire. Future delivery of silver as collateral. The entire Spanish economy was leveraged to the hilt on the expectation of future supply. Paper promises exceeded the physical metal sitting in the vaults. When a storm delayed the fleet, or when English privateers intercepted a convoy, the leverage unwound violently. The price of Spanish credit would crash, liquidity would dry up instantly. In 155-71575, 1596-160-71627, and 1647, the Spanish crown declared bankruptcy. These were not polite renegotiations. These were systemic defaults that shattered the banking houses of Europe. During these crashes, the paper claims on silver became worthless, even though silver itself remained valuable. The bankers who held the paper contracts were ruined. The physical silver, when it finally arrived, was seized by the crown or diverted to pay immediate demands. For the average Spaniard, this meant a century of the price revolution. The cost of wheat in Castile rose by more than 400%, but it was the volatility that destroyed the social fabric. A merchant in Toledo could not plan for the future because the value of the currency fluctuated wildly based on rumors of the fleet's arrival. The paper silver market of royal debt created a false sense of abundance that suppressed the warning signs of fiscal insolvency. When the crash came, it didn't destroy the silver, it destroyed the paper claims on the silver. The physical metal flowed out of Spain to pay creditors in China and the Levant, leaving the domestic economy hollowed out. The empire collapsed, not for a lack of resources, but because it had financialized its greatest asset until the leverage became a weapon against itself. Just like Spain leveraged its future production, the Weimar Republic in early 20th century, Germany demonstrated the final chaotic phase of paper decoupling. We often think of the Weimar hyperinflation as a straight line up, but the reality was a period of sickening volatility. In the years following World War I, the German government was burdened with impossible reparations and a shattered industrial base. They chose the monetary shortcut. They printed the paper mark, but there was another currency, the gold mark, which represented the pre-war standard of real value. The relationship between the paper currency and the hard asset became the only chart that mattered. In the early stages, specifically around 1920 and 1921, there were periods where the paper currency actually strengthened. There were days when the price of gold and silver in paper marks crashed. Speculators who had bought hard assets on margin were wiped out during these temporary pullbacks. The volatility was designed to shake out the weak hands. It was a washout of leverage. In 1922, the illusion finally broke. But notice the mechanics of the collapse. It wasn't that the supply of bread or silver changed. It was that the velocity of money exploded. The German middle class, the teachers, the clerks, the pensioners watched as their life savings were annihilated. A famous anecdote from the period describes a woman who who brought a wheelbarrow full of cash to the bakery to buy a loaf of bread. When she went inside to negotiate the price, she left the wheelbarrow outside. When she returned, the money was dumped on the ground, and the wheelbarrow was stolen. The physical asset, the wood and metal of the wheelbarrow, had infinite value compared to the paper. During this time, the paper price of silver and gold moved millions of percent in a day. But if you looked at the charts in real time, you saw massive corrections. You saw 30% drops in the price of metals in paper terms, driven by liquidity crunches in banking. Holidays. These crashes were traps. They lured people back into the paper currency just before the final explosion. The crash of the metal price was a signal of distress in the paper system, not a reflection of the metal's worth. Those who held physical silver and gold preserved their purchasing power. Those who traded paper contracts or held cash were erased from history. The arithmetic of the Weimar collapse proves that in the end, the paper price is a political fiction, while the physical weight is the only truth. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money. The currency is backed one-to-one by physical assets. Trust is high expansion, is driven by productivity and savings. The economy grows on a solid foundation of real capital. Stage 2 is the imperial overreach. The state's ambitions exceed its income. Wars, welfare, and bureaucracy require more funding than taxation can provide. The government begins to borrow heavily, creating the first layer of leverage. Stage 3 is the monetary shortcut. The leadership realizes they cannot pay their debts honestly. They begin to debase the currency. In Rome, this was adding copper to the silver in the modern era. This is quantitative easing and the expansion of the balance sheet. The currency is diluted, but the effects are not yet felt by the general public. Stage 4 is the financialization and paper markets to hide the inflation. The state and the banking sector create complex derivatives. They create paper silver and paper gold. They sell contracts representing metal that does not exist. This increases the supply of virtual metal, suppressing the price and masking the devaluation of the currency. This is the era of the naked short. Stage 5 is the volatility and the washout. This is where we see the 30% crashes. As the leverage builds, the system becomes unstable. Any shock to liquidity forces leveraged players to sell their paper positions. Prices of hard assets crash in the short term, even as the fundamentals scream for higher prices. This stage confuses the public and bankrupts the speculators. Stage 6 is the flight to reality. The public realizes the game is rigged. Trust in the paper promises collapses. Physical metal vanishes from the market. Premiums on physical coins explode, decoupling completely from the paper spot price. You cannot buy silver for the screen price. You must pay double or triple if you can find it at all. Stage 7 is the restructure. The currency is destroyed. The debts are wiped out through inflation or default. A new system is introduced, often pegged back to hard assets to restore confidence. The wealth transfer is complete. Those who held paper have nothing. Those who held physical have everything. Just like Rome, Spain, and Weimar, we are currently living through the late phases of this cycle, specifically the transition between Stage 4 and Stage 5. Current data suggests the leverage in the silver market is at historical extremes. The COMEX, the primary exchange for silver futures, operates with a ratio of paper contracts to registered physical inventory that defies logic. Estimates range, but it is widely accepted that for every ounce of physical silver sitting in the registered vaults, there are hundreds of ounces of paper claims traded daily. This is the fraud the title refers to. It is not a criminal ring in a back room. It is the structural design of the market. The mechanism of the 30% crash is simple. Big players, often bullion banks acting as custodians, can dump billions of dollars of paper silver onto the market in milliseconds. They do not need to possess the metal. They only need to possess the margin. This flood of paper supply triggers stop-loss orders from technical traders. The algorithms cascade. The price collapses. Hedge funds and speculators are forced to liquidate their long positions to cover margin calls. It is a forced sale. The price on the screen turns deep red. But here is the key. While the paper price crashes, does the physical inventory grow? No, in fact, during these price smashes, physical demand often accelerates mints, report shortages, dealers widen their premiums. The spot price says silver is cheap, but try to buy a monster box of American Eagles at that price. You will find that the paper market and the physical market are two different worlds. The crash serves a dual purpose. It clears out the leverage of the speculators, and it allows the smart money to accumulate physical positions at artificially suppressed prices. The incentive is to keep the price low to maintain confidence in the fiat currency. If silver were to rise to its true inflation-adjusted value, it would signal the death of the dollar. Therefore, the paper market is used as a leash. Some economic historians note that regulators exist to prevent this manipulation. They argue that the CFTC and other bodies ensure fair markets. However, the historical record shows that in times of sovereign debt distress, the regulator's primary mandate is financial stability, not price discovery. If a true price discovery mechanism were allowed to function, the insolvency of the bullion banks and the currency itself might be exposed. Under these constraints, the rational move for the authorities is to look the other way or to actively encourage the suppression of volatility. The tamp down is a feature, not a bug. It is the modern equivalent of Diocletian's price controls. It works until the physical shortage becomes acute. We are seeing signs of this stress now. Inventory levels at the COMEX have been draining steadily. Silver is moving from the west to the east, from London and New York to Shanghai and Mumbai. The east is exchanging paper surplus for physical reality. They are positioning themselves for the end of the paper cycle. The end game approaches in one of three ways. The first possibility is a controlled decline. This is the soft landing scenario. The authorities manage to devalue the currency, slowly allowing inflation to run hot, but keeping the paper markets functioning. Silver prices rise, but in a jagged, volatile line. The middle class is slowly boiled, losing purchasing power year over year, while the paper games continue. This mirrors the British Empire's decline in the mid-20th century. The second possibility is a chaotic collapse. This is the Weimar scenario. The paper shorts are squeezed. A physical shortage forces a delivery default on a major exchange. The paper price becomes meaningless. A market snaps. Silver goes no offer. You cannot buy it at any price and currency. The system freezes and trade moves to the black market. This is the most dangerous outcome, leading to social unrest and a total breakdown of the supply chain. The third possibility is a reset and restructure. This is the most likely long-term outcome. Governments acknowledge the debasement and introduce a new currency, perhaps a central bank digital currency, CBDC, potentially with a partial gold or commodity backing to gain trust. In this scenario, the price of silver and gold is revalued overnight to a level that balances the global balance sheets. It is a one-time step change, a repricing of reality. Holders of physical assets are preserved. Holders of paper assets are bailed in or converted at unfavorable rates. This mirrors the outcome of the U.S. Gold Reserve Act of 1934, where gold was revalued from $20 to $35 by executive decree. The only variable is timing and pain. The crash you see on the screen is not a signal to sell. It is a signal that the system is fighting for its life. It is a signal that the divergence between the promise and the payload has reached a critical limit. Do not be distracted by the daily fluctuations. Do not be shaken out by the volatility. History does not reward those who trust in the paper promises of dying empires. It rewards those who hold the physical remnants of truth. Subscribe to continue this investigation. Educate yourself on the mechanics of the market. Watch the inventory levels, not the price. Prepare your mind for the volatility to come.